Three, two, and one. What's going on, everybody? Welcome back to Wolf. It's good to see you all here. We are live. We're back in action, baby. Had a few days off, but we are back, and we're talking markets. We got Mr. Robert Infra, as always, on the show today. He's going to talk about all the things that have gone on over the weekend. I feel like it's been like ages since I've checked in, even though it's literally been like 3 days. A lot of things going on in the news, and so we're going to talk about all the things. We're going to talk about the energy, the AI markets. We're going to talk a little bit about how the equities are doing. Bitcoin's up like 1 or 2%, not doing too bad in the 70s, low 70s right now. I actually ran a poll the other day, and at least our audience, good number of you are thinking we see 60K before $80,000 Bitcoin. So that was interesting. Depending on which, what your algorithm is, I guess, on crypto Twitter and Bitcoin Twitter, you probably have a bit of wavering opinions on that right now. But we're going to talk about all the things, man. Talking about oil. Let's see what Robert's kind of paying attention to. If you guys haven't already, please do take a second and repost the stream if you're watching this as we get this show on the road. And yeah, man, Robert, dude, let's pass you. Well, not to pass you the mic. I need to have another phrase for this for the stream. I'll just turn it over to you. I'd love to get somebody just your quick foundational thoughts on where you're seeing these markets. I saw you were in some pretty big spaces over the weekend. I know war is still top of mind for a lot of people. They're trying to figure out what the heck is happening and how the markets are going to react. I see all sorts of macro analysts still calling for bubbles. They're saying it's coming, but then it seems like we keep trudging forward. I saw gold have a massive retracement. So there's all sorts of things that are happening right now. Where are you sitting?
Yeah, it really depends on the war. So that's kind of the ultimate determining factor now. Everything is dependent on that. You have VIX tracking oil. And VIX, obviously, if VIX is tracking oil, then the higher oil goes, you're going to have an inverse correlation with risk assets like the stock market. So the inverse correlation there with oil. Yeah, it's all kind of one thing. You got bond volatility up, you got rates up. Rates are also following oil, and oil, right? Keep coming back to oil. Oil is just dependent on what is going on in the Middle East. Oil is just dependent on how long is the conflict going to last? Is there really an off ramp? Is there not? That's kind of ultimately what oil is trying to figure out. Today, we saw some pretty crazy moves here. I'll pull up SPY, or I guess front month futures. So this morning we saw a huge giga pump. I mean, like wild move in the S&P 500. So in 5 minutes, just this one 5-minute candle is a 3.3% move in a $65 trillion market, which is the S&P 500. So it's pretty insane. This was due to President Trump basically claiming that, he's not going to attack oil infrastructure or energy infrastructure in Iran. He had threatened that, right? He had given a 48-hour deadline a couple days ago. He had said, look, either the Strait of Hormuz is reopened in 48 hours, or we're going to annihilate your energy infrastructure.
That was crazy.
Yeah. And so on that news, we had Bitcoin sell off quite significant. Well, I guess for Bitcoin, not too bad. It was like a 2% sell off on Bitcoin over the weekend when we got that news. Yeah, it was here. So, that makes sense. It's a huge escalation in the ladder of escalation in war because Iran then threatened, okay, well, if you attack our energy infrastructure, we're going to go after your desalination plants. Now, in the Gulf, in the Middle East, especially the Gulf region, they heavily rely on desalination for water. So, you could kill. I mean, it would be really, really bad. Not only do they rely on imports for their food, about 90% of GCC food comes from imports. So you're already in a pretty sketchy situation if you're in the Gulf. But once your desalination plants are attacked, you're really, really, really in a sketchy situation. People can live for, weeks without food. You can only go a couple days without water. So, that was obviously a huge escalation, but Iran also threatened to go after more oil infrastructure in the Gulf. So, we didn't have oil trading at the time, but, when that threat was made by Trump, 48 hours, open the strait, or else we attack your energy infrastructure. And Iran said, okay, fine, that's fine with us. If you do that, we'll attack your infrastructure. I'm sure, if oil was trading, it would have gone up, 8, 9, 10% probably on that news. We already are living through the largest energy disruption, the energy crisis in modern history. So the Strait of Hormuz traffics about 20 million barrels per day of oil. The total demand for oil per day is about 105 million barrels per day, called 100 for easy math. So you're talking about a 20% reduction in the supply of oil from the Strait of Hormuz being effectively closed. Now, it's not militarily closed, it is effectively closed. But that's kind of a distinction without a difference when you're talking about a 20% overnight, basically, very, very, very rapid 20% reduction in oil, in the supply of oil. Now, when we talk about supply and demand, when it comes to energy, obviously supply and demand must equal out, right? You cannot print oil. So if the supply of oil is going down by 20 million barrels per day, what that means is demand for oil must go down by 20 million barrels per day. What does that actually mean? That means consumption of oil must go down by 20 million barrels per day. Well, what does that mean? That means economic activity, right? If you reduce consumption by 20 million barrels or 20%, if you have a 20% reduction in the demand or the consumption of oil, you're basically talking about a 20%, arguably even more. There's kind of a multiplier effect, at least a 20% reduction in kind of global economic activity. Luckily, we know what this kind of looks like. So you can go back to 2020. Back during Q2 of 2020, we had obviously a huge imbalance between the supply and demand for oil. We had, in that case, we had demand just absolutely cratering because the global economy had shut down. Well, this is what happened to oil. It went to negative $40 to clear that supply demand imbalance. You had to have oil go to negative $40 for enough demand to come in to clear the market. So that was what a 23 million barrel per day reduction of oil consumption demand during the height of the COVID lockdowns in 2020 Q2. We saw a reduction in demand of about 23 million barrels per day. So we're talking, that's what it looks like. That's what the world looks like when consumption of oil goes down by 23 million barrels per day. Well, the Strait of Hormuz traffics 20 million barrels per day and is gone. It's not, you can't print oil. You cannot print molecules. You can stimulate demand, right? If demand is falling, you can always print money. You can print $10 trillion in an afternoon, if you wanted to, but you cannot print actual oil. You cannot print molecules. You cannot print supply of physical commodities. This is really the issue that we're running into right now, which is that, look, if 20 million barrels per day of oil is just gone, eventually, right, there is some kind of buffer, right? You have the stockpiles that Japan, all the developed countries have a stockpile of oil. That stockpile can get ran down, right? We have the SPR here in America, which has been ran down, which was ran down quite significantly in 2022 ahead of the midterms. Is not really been rebuilt by the current president. But you have a stockpile, right now, 415 million barrels in our stockpile, in the U.S. stockpile. We got 415 million barrels. And again, that is about 4 days worth of global oil demand. 4 days worth of global oil demand. Now, obviously, we don't, here in America, we don't have to worry about global oil, right? But oil is priced on an international market. Now, there is some variation, right? There is WTI, which is West Texas Intermediate Oil. That is the benchmark for US oil. That can diverge from the kind of global benchmark, which is Brent. So when you hear people talking about WTI and Brent, that's what they're referring to. Brent is just a different oil benchmark. That is what Asia and Europe are concerned with. You can see a situation where US oil, right? Oil is oil, you would think, but you can see a situation where US oil is cheaper than UK oil, than Japanese oil, the Brent. So there are some nuances to it, but in general, the stockpiles that are being held by these countries are not nowhere near enough to cover more than maybe 2 months worth of global oil demand. So you have that. But the problem with the stockpiles is the flow rate. So we talked about how the global oil demand per day is 105 million barrels per day of oil is consumed every single day. Well, call it 100 for easy math. What we're talking about with the SPR release, not just in the U.S., but the International Energy Association, the IEA, we're collectively we got together and decided to run down our reserves in tandem. The problem there is not the 400 million barrels or 800 million barrels. That's not the problem. The problem is the flow rate. So the flow rate, at least using prior data that we could assume, the maximum flow rate of all of these stockpiles combined together, you're only talking about 2.5 million barrels per day. So you've gone from 20 million barrel per day disruption down to 17.5. 17.5 is still very close to the amount of economic pain and economic contraction that was required to destroy demand during COVID, right? That was 23 million barrels. We're talking about 17 and a half already. Now, there are other offsets. So there's a pipeline that goes from basically kind of the north down into the Red Sea, terminates in Yanbu, a city in Saudi Arabia. That pipeline can be increased by about 3 million barrels per day. So now you're down to about 15 million barrels. The problem is Iran has attacked Yanbu refinery. We know we have footage of Yanbu refinery on fire just maybe, I don't know, 2-3 days ago. So we know that if Iran wanted to, they could take that 3 million barrels back offline. Right. And so you're very quickly back to a 17.5 million barrel per day disruption or negative shock. Well, that's 8 times worse than maybe even 9 times worse than the Russia-Ukraine war of 2022. Of course, we know, the result of that. We got skyrocketing energy prices. And here in America, we had 2 quarters of negative GDP and we had an equity bear market. So, that was 1/7 or 1/8 of how bad this potential disruption, this current disruption is. And the other issue is shut-ins. So you already have 8 million barrels per day. If you're a refiner, right, you're an oil producer in Kuwait, you're making oil, you're bringing it out of the ground, you're putting it into tankers or pipelines or whatever, you're transporting it out, right, you're selling it. Well, what happens when you can no longer do that? When there is no exhaust valve for the oil to leave your complex, you fill inventory. So these are big tanks that store oil. Well, what happens when the tanks get full? When the tanks get full, you got to stop production. Can't just let the oil go out onto the Arabian sands, right? You have to stop production. That is known in the oil industry as a shut-in. Well, we're already talking about 8 million barrels per day of shut-ins. So this is like net all in. This is very, very, very bad. This is bad on a biblical level. This is bad on a historic, there are no words to describe how bad this could potentially be if there is not a rapid, within the next week or two, rapid de-escalation of the war. And even then, oil prices are probably not going to go back to 60 anytime soon. They might go back down to like 90 on Brent. But the amount of supply disruption, look, this stuff is, when you talk about shipping oil, you talk about refineries being damaged, by the way, in this war, that takes some time to repair. A lot of this stuff is, in the physical world, and things in the physical world don't function with like a light switch. Takes time to get the tankers that are all clustered up. By the way, the people on those ships are running out of food and water, which is kind of an interesting story there. It takes time to get those tankers out, right? They only travel, I don't know, 100 miles per day or something. They're kind of slow, right? So it takes some time for the oil that is in those tankers that are piled up in the Gulf, takes some time for them to get to Asia, to get to Europe, wherever it may be. It takes some time to get there. Once you shut in a refinery, you don't just turn it back on. There's issues with actual physics of oil extraction that, is far beyond my head. But needless to say, there is a delay there. You don't just turn the refinery back on. It takes a couple months, according to the kind of oil people. It takes a couple months, and that's assuming there's no damage to the refineries. So this is really bad. This is, we're talking about, economic contraction on par with kind of the depths of COVID. And, for what that looked like, here I'll pull up the GDP print for 2020. Oh, I guess that's Adobe. I'll have to pull it up here. Here's what GDP looked like during this period of time where demand for oil fell by 23 million barrels per day. The U.S. economy shrank about 30%. So about a third of the U.S. economy just vanished, just poof, into thin air. That is the scale. And of course, it wasn't just the U.S. It was every country's GDP was contracting, 20, 30%. That is what is required to reduce the demand or consumption of oil by 23 million barrels per day. And again, even under very optimistic circumstances, we're talking about, call it 15 million barrel per day supply reduction. Well, what that means is that demand for oil must fall by 15 million barrels per day because you cannot print oil. So, we're very close to the economic contraction, the economic pain, the economic slowdown that was the depths of COVID and those lockdowns, right? When the streets were empty, every bit, I was working in healthcare, so I was an essential worker and out and about, and it was nuts. I live in LA, and it was just like the 405 was just empty. In the middle of the day, it was wild. That is what it looks like when you destroy 23 million barrels per day of consumption of oil. And we're talking about needing to destroy 15 million barrels. Now, that gets into a whole thing about price and the price elasticity of oil, which is oil is very inelastic. What that means is that in order to destroy that much consumption of oil, the price of oil has to go up really, really a lot. And if you think about it, oil's gone up 50% in the past couple of weeks, right? At least here for WTI. So, did you stop going to, driving to work every day? No. Did you stop going to the grocery store? No. It takes, and then ask yourself the question, what oil price, what gasoline price, diesel price, whatever it may be, what price would be required to get you to stop driving to work, to stop going to the grocery store? That is what the elasticity, that is what that is referring to, is basically, a very, very elastic commodity. Price doesn't have to go up very much for you to stop using it, for the demand to change and go lower. But an inelastic a commodity like oil, very inelastic, 0.1 in the short run, even as low as 0.06 in the short run, what that means is that the price has to go up like an astronomical amount. I was running some calculations, and you're talking about like $200 to $250 Brent, given the current situation.
I saw, that chart is insane. I saw Thomas Young jump to the chat here. Big shout out to Thomas Young, one of my favorite people on this planet. He said, Robert, I think people are underestimating the economic effects of this. Also, a few minutes before that said, he asked if you could talk about duration effects and what your thoughts are realistically there. And yeah, if you have any thoughts on that.
Well, yeah, the longer it goes on, the worse this is going to have to be. There are these buffers, right? There are inventories in refineries, right? I live in LA. We have refineries here in America, right? Here in LA. They have tanks. They have in those inventories we were talking about. Those can be ran down. You have the strategic stockpiles that various countries have accumulated. Those can be ran down. But again, you're talking about, a time a constraint, right? Which is that, for example, the SPR, the strategic stockpiles of all these various different countries, it's only going to last like 2 months. So what happens, and again, that's adding back in. We took down 20 million, right? We're adding back in 2.5 million. But that 2.5 million that we're adding back in is gone in like 2 months, maybe 2.5. So yeah, if this goes on 2.5, 3, 3.5, 4, you just wasted your stockpiles, and the same issue is going to hit, which is that demand has to fall by really a lot. And again, when demand for oil falls, the other way of phrasing that is consumption of oil has to fall. Well, consumption of oil falling, another way of saying that is that you're in a recession, right? You're in arguably a depression. I mean, we are staring down a potential crisis that could very well, not theoretically, very well in practice, cause a global depression. I mean, the scale of this is really underappreciated by the vast majority of market participants. Clearly, you have the S&P 500 up 1% on some lie from Trump today, some blatant market manipulation, and you have the S&P 500 up 1.1%. Clearly, they haven't woken up.
Do you think it's that they? You think they like the people on like the TVs and stuff? Because a lot of them are running their own funds. So for them to even acknowledge what you're talking about puts their fund literally at risk.
Yeah.
Their investors, and if their investors start to panic and they start to panic sell, then the next person starts to panic sell, and
Yeah.
this guy's providing liquidity to this guy, and it's just like that's exactly how the dominoes fall, isn't it?
Yeah, it's they got incentives to protect. So yeah, you're not going to get them admitting, look, guys, I think that right now, as we stand, given the numbers that I've ran and found, right, because this is very simple. We're talking about the physical world. It's one thing to try to put a price or a value on Bitcoin, right? How do you do that? It's kind of artistic almost, right? Like it's kind of theoretical. And no, we're talking about physical barrels of oil. And we know, how many have been taken offline by the Strait of Hormuz being closed, effectively closed. Traffic, Bloomberg just had a thing out yesterday that I was reading. Traffic is down by 97% in the Strait of Hormuz. So, we know 20 million barrels per day of oil is gone. We know that this pipeline that goes from the north of Saudi Arabia down into the Red Sea, so kind of diversion, we know that could be increased. There's already oil flowing through that pipeline. That doesn't matter. We're not talking about that. That was already there. We're talking about disruption and then adding back in, right? That can be increased by 3 million barrels per day. We know about the SPR, right? We know because they're announcing not only the amount of oil they're going to release, but the schedule. So we can calculate the flow rate for that. This is all like the physical world. It's just barrels of oil. Like it's pretty straightforward. It's not theoretical. It's not mumbo jumbo kind of artistic kind of thing, right? Like interpretive. It's not. It's physical math. It's physical commodities that we cannot print. We're very good at printing, money. We're very good at financial derivatives and all this kind of nonsense. But, there's been decades of historic underinvestment in the physical world. And now granted, hopefully, or not hopefully, Luckily, the US is a net energy exporter, so that kind of helps cushion things a little bit. The problem there, and the reason that this is arguably we're already past the point of no return, is that if you're in Europe and you have Brent going up, in dollar terms, well, that's already bad enough, right? Here's the Brent oil chart in dollar terms. That's already bad enough. And it's already up, significantly. If we go back here to say the start of February, even after today's pullback, it's up 50%. So that's already bad enough. But then you factor in the fact that the euro has weakened. So if you're in Europe, again, we're talking about the Brent oil price in dollars. But if you're in Europe during that same time period, the euro has weakened, meaning that you're actually paying even more than the Brent oil price in dollars would indicate, right? So I would recommend to people that, like track, are watching markets and stuff, don't really look at the Brent price in dollars. Look at it in yen, look at it in euros, because that's really where the strain is. So what happens when these countries are strained? Well, luckily we have some evidence of kind of, how that goes. So here is the inverted current account for France, and then the price of oil. And we can see a very tight inverse correlation. So the current account is inverted here. So I'll put that. So we have the inverted current account. This is mainly comprised of the balance of trade, imports, exports. And we can see that when oil goes up in dollar terms, the current account is pressured, right? The country's finances, they are pushed further and further into deficit. There's a very, very tight now. 2020, a lot of chaos with 2020. There's going to be a divergence there. But generally, like we can see here in 2022, as oil was running up, that was causing the French current account to get pressured with a, maybe a 1 month lag, a 2 month lag, something like that. But generally kind of one for one. And that is due to the fact that they're net energy importers. Well, if you're getting pushed into a 64 billion euro per month current account deficit, how do you fund that? Well, you fund that by selling dollar denominated assets. And sure enough, we know we can look at the data in 2022, Asia and Europe, which are both net energy importers, they sold about $700 billion worth of US treasuries, just US treasuries. I haven't ran the data for equities, but just US treasuries, they sold $700 billion worth of US treasuries, again, because they had to fund. You need oil, you need energy, you need diesel, you need gasoline. You do not need to import US treasuries. You sell what you can, not what you want to. And one of the ways to fund a current account. Now, remember, also they have very large benefits programs, right? Pension fund, all that kind of thing. In Europe, government spending is like 50% of GDP. It's nuts.
Wow.
So you have to fund that as well. So, everything is being pressured with a higher oil price. Oil goes into everything, gasoline, diesel, all the refined products kind of, secondary to oil. It increases the price of everything, especially in the interconnected world. Well, in that interconnected world, just because we might have an export ban here in America, we're keeping our oil, for ourselves. We're not sending it out to you guys anymore. We need it. That doesn't make us immune from economic pain, right? Because if oil is going up in price, it's going to pressure all of these countries, whether it be France, whether it be Japan, whether it be, South Korea, UK, they're all going to be hurt. And again, the way that they come up with the money needed for energy, needed for pharmaceuticals, right? There are certain things that you just kind of need, right? There are certain things you can do without. Maybe the imports into the UK of like Gucci handbags, right? You don't really need that, but there are a lot of imports that are required, especially energy. The way you come up with the money to fund, an ever larger current account deficit is by selling of US treasuries, US stocks. We know the rest of the world owns $65 trillion worth of dollar denominated assets. They start selling dollar denominated assets, two things happen. On the US Treasury side, that causes rates to go up. Well, as rates go up, the dollar or the interest-bearing dollars, US Treasuries, become more attractive for global capital to flow into. So more money flows into the dollar because, again, you need dollars to buy a US Treasury. So more money into the dollar means the dollar gets stronger. Well, what were we just talking about with the price of oil? If the dollar is getting stronger, the price of oil could go sideways, and the burden for Japan, the burden for the EU is getting larger. Even if the oil price just goes sideways, the burden is getting worse due to the fact that the dollar is strengthening. So what does that increased burden mean? That increased burden means more US Treasury selling. Well, what does more US Treasury selling lead to? Higher rates. What does higher rates lead to? More dollar strength. More dollar strength, more burden on the economy, more burden on the economy, more selling, and on and on and on and on and on and on. It's a reflexive loop.
Jeez.
Then on the US equity side, it's just as bad, just in a different mechanism. On the stock side, you get selling of stocks. Well, what is the one thing that US GDP is predicated on? It's predicated on consumer spending. It's about 2/3 of GDP. And we know of that 2/3 of GDP, half of it is being done by the top 10% of income earners. That top 10% of income earners own 90 to 93% of household equity exposure. So they own all the stocks. They've been feeling very rich recently because, the stock market's been generally going up. So they feel very rich. They spend more money. That's called the wealth effect. Well, what happens when the price of stocks starts to go down because foreigners are selling them to raise dollars to pay for energy? Lower stock prices, the wealth effect goes in reverse, and that 2/3 of GDP goes maybe not so healthy. And we go into a recession. So it's we're not immune. We can try these little tricks, export ban or this or that, like shorting WTI future. We can try all of that, but we're not avoiding the amount of economic pain because, again, even optimistically speaking, we have just taken down 15 million barrels per day of oil offline, which means demand must fall by 15 million barrels per day because you can't print oil. So we're not going to escape by any means. And if you go back to 2022, you can see how stocks held up. They did not hold up very well.
Question. So with the crypto and the Bitcoin markets, where a lot of people are accustomed to the massive pullbacks because we're like, hey, if we're going to go higher, we need to get lower prices so people can get back in, and this is how the markets move, blah blah blah. And that's a small sector of investors, very small sector compared to the equities markets, the bonds, all these things. But in my head, that always made sense. If we're going to go higher, eventually there's always going to have to be these massive recessionary periods where prices are down for a while. Like you're saying, the rich accumulate. They continue to be the top holders of these stocks and these assets and stuff. In my head, I'm like, it feels inevitable that you're going to have these big recessions and bear markets. This is what everybody says too. But at the same time, I was thinking because you're talking about oil, you're talking about people literally having to sell just to make sure they have energy. And I was like, man, but this time, when you're talking about the world economy, the global economy, these types of assets, you're talking about lives. You're talking about depression. You're talking about jobs. People don't have jobs. It affects people in a completely different way than people's 1% of their portfolio in Bitcoin and Ethereum kind of thing. It's an entirely different conversation. But it's also these things have to happen. If you're going to go higher, there have to be these massive pullbacks in periods of flat and down. I guess I don't know what your knee-jerk reaction is to that, or how you think about that. Is there a better way to think about it, or is that pretty much just how it is?
Yeah, we've needed a recession for a long time. The problem with a recession is it's going to lead to an amount of money printing that'll be absolutely unbelievable. That's really ultimately the problem. Is a recession acts as a margin call on unproductive debt. That's really the problem. And during 2022, Bitcoin did not escape very well either. Also, I'll point out that we got 2 quarters of negative GDP. We got a bear market in the stock market, but which used to be the definition of a recession, by the way, consecutive quarters negative GDP. That was changed for political reasons, but it would have been so much worse. You also have to remember 2022, we had just printed $5 trillion, right? So there was a ton of liquidity sloshing around the system. Number one. Number two, the labor market was red hot. I mean, arguably, there's never been a more red hot labor market. So, the 2022 recession, right, the stealth recession or whatever you want to call it, where you did get the bear market, you did get the 2 quarters of negative GDP. The reason it wasn't worse is because we had just printed $5 trillion. Labor market was red hot. Wage gains were solid, right, on and on. So the economy was in a much, much, much different place. And again, the disruption we're seeing today is 7-8 times worse than 2022. It is by far the largest energy disruption, energy crisis in modern history. And again, you can't print oil. So this is really, really bad. And, like I am not one to call for recession. In fact, I've been mocking the people calling for recessions for the past 4 years, because they've been wrong. Whether it be the perma bears that go on like Adam Taggart's show every day and they're talking about, oh, stock market's going to crash and this and that. Like, they've all been wrong for 4 years. And I've been, pretty open about being constructive on the US economy, on risk assets like the S&P 500. And I've been right. So for me to be talking about not only just a recession, but a depression, I don't think people understand how bad this really is. And I would just recommend, it's the physical world colliding with this kind of paper fake world that we've decided to structure everything off of. And it's going to be a violent reconciliation when those two meet. And we're just in the early stage, right? We're only 3 weeks in. And so we're in the early stage of this. To Thomas's point, like, if this goes on another month, 2 months, 3 months, 4 months, it's biblical. I mean, it's a global depression. There's no other way to describe it. In order to destroy that much demand and keep it destroyed, you're talking basically 20% of the global economy gone, global economic activity gone. And again, what that looks like in like kind of real world terms is the depths of 2020 and the lockdowns.
You mentioned like a second ago, you mentioned you were like, we've needed a recession for a while. Talk to me a little bit about, I want to move into Bitcoin a little bit as well as the crypto markets, some of these treasury companies, the miners. I know there's a couple of the ETFs in Rex shares regarding the just energy in general. And so I know like the miners, energy is starting to move together, the AI world, they're all starting to converge together. So I want to move into this, this conversation around Bitcoin. We can start with the energy stuff, or if you want to start with Bitcoin, happy to go either way.
Yeah. So Bitcoin, like I haven't worked out from the energy standpoint. I haven't really worked out kind of like how that is going to work, right? Because you have higher energy price. So, does that cramp miner margins, like with the difficult? I don't know. I haven't really like thought through how it affects Bitcoin from an energy perspective, but I will say that, like, man, if we're talking about a reduction of oil consumption, of oil demand of 15 to 20 million barrels per day, Bitcoin is going way lower. Like, I don't see a world where, I mean,
you got any levels drawn for where that goes? Like, you're talking
like if we were 4 digits. Yeah, like really, I mean, it would be, number one, Bitcoin has never lived through a recession, right? We had the stealth one where from the high in 2022, we fell by 77%. Well, let's say that maybe Bitcoin has been front running some of this, right? That would take us down to about 28,000. If Bitcoin was front running, and somehow knew about Iran and all that, which I think is a stretch, you're already there. right? You're already in the 20s
Good
if
Lord.
you're. But again, this energy crisis is 7 to 8 times worse than 2022 was. 7 to 8 times worse, 900% worse. Like, yeah,
Robert.
you're talking like very low. I mean, look,
Dude.
is there a world where suddenly all of the Bitcoin people, right, that view Bitcoin as money, not as, you know, a speculative asset, but look at it as money? Is there a world where they suddenly go from 0.2% of the market participant population to 90%? Yeah, I guess. How? I have no clue. Right? Like, just because, you know, some Bitcoin space or some dude, you know, that's really enthusiastic about Bitcoin looks at it as money, or thinks it should be looked at as money, that is totally irrelevant to whether or not the market views it as money. And again, the market, generally speaking, looks at Bitcoin as a high beta speculative asset. Now, you can disagree with that view, and you can find an arbitrage opportunity, kind of, right? A value point of value where, oh, you know, Bitcoin's been selling off really hard here. It's getting crushed with all the high beta stuff like Palantir, but it's not a high beta stock, right? It's Bitcoin. It's a scarce, decentralized, right, uncensorable money. I'm going to buy it here because, right, that is worth more than the market is discounting or saying right now. You can have that, but to try to claim that like Bitcoin is somehow going to like go up in a depression where, you know, the amount of deflation. I mean, again, to go back to GDP, a third of the U.S. economy just was gone, like in a quarter, right? In a 3-month period of time. I was looking at the second read GDP, and it was 32%. Yeah, 32% reduction for the second read of second quarter 2020 GDP. A third of the U.S. economy just gone, poof. That is immensely deflationary. How does Bitcoin go up in that and not just go straight to the depths of Valhalla? Like, you know, maybe suddenly somehow everyone in the world wakes up to Bitcoin as money.
Yeah.
Maybe, sure, I could be wrong, but
I see what you're saying.
it's very unlikely. I think Bitcoin would go much lower.
Would you in that scenario, are you questioning Bitcoin as an asset?
No. And the reason, and this is important, I'm glad you asked that. Normally I don't forget to mention this part. The reason is what the second order effect or the third order effect of this is what's really probably important. Now, that initial deflationary shock is going to be very severe if this war is not ended rapidly and quickly. That initial deflationary shock is going to be immense. Similar again in kind of scale to 2020, but what comes after it is going to also be immense, which is the amount of money printing. So in a recession, the deficit as a share of GDP goes up. And this is due to the fact that revenues go down and expenditures go up. Well, if you're in a recession, at least, if not, you know, a depression, you're talking about a deficit as a share of GDP, probably 15%. We're already at about 6.5. So, you know, you add another 700-800 basis points on that. You're talking about like a 15% budget deficit as a share of GDP. You're talking about a $5 trillion per year budget deficit. That's untenable, right? What did the government do here when the deficit reached 20% of GDP in the depths of COVID? It, of course, printed $5 trillion. Well, $5 trillion per year deficit, the Fed is going to have to backstop a significant portion of that. Call it a quarter, maybe a third. So you have them printing, call it $2.5 trillion for the U.S. Treasury debt that is needing to be issued and purchased to keep the lights on in the government, in the federal government. So $2.5 trillion there. You got private credit blowing up. That's probably $5 trillion, including cross collateralization. the Fed's printing, another 1.5 trillion. They're talking about 4 trillion. The mortgage market's going to be blowing up. So, you got to print, call it another 2 trillion, 6 trillion. Like, you just start kind of playing that game out, and the amount of money printing is going to be immense. And so, what I would recommend is, I know it's heresy, this is just what I'm doing, building a very large cash pile.
How dare
you? Yeah, and getting that 3.3% T-bill money market rate, building a very large cash position so that, when things inevitably crash, I can scoop them up and then ride that wave of printing, because it will happen. The alternative is they let the entire financial system collapse. They let the entire economy collapse, and therefore the government, and therefore the society. They're not going to. The recession or depression, it'll just be even more severe of a margin call. They both act as a margin call, and the way that margin call will be met is, unlike you, right, that might get margin called and you got to sell some stuff, move some stuff around to come up with the cash. Unlike you, the government can just print the money. So that's what they'll do. They'll print the money, and Bitcoin might go to 20K. It might go to 5K, but then it is going to 500K, right? Or, I don't know, something much higher.
Do you think Bitcoin would be the highest asymmetric upside?
Oh yeah, for sure.
Those levels?
Yeah, because high beta works both ways, right? High beta crushes you on the downside. Yeah. And we've seen this, right? Going back to like that late October kind of period, we're down, 50%. Whereas, other low beta assets are maybe down 5, 10, 15. So that high beta works, really painful on the downside, but it also works on the upside. And usually they are the first things to move.
Of course. Good, dude. Could you imagine getting an average price at $5,000 Bitcoin again? Getting that type of entry when we've seen it go to 6 figures, that would be ridiculous. That'd be the entry of a literal lifetime.
The chart's gonna look pretty wild at that.
It's gonna be so bad, dude. Like we're gonna be getting clowned for rebranding Wolf Bitcoin at literally $124,000. It's gonna be bad, dude. But the return will be biblical.
Just to put it in perspective, this chart goes all the way back to 1948. So right after World War II. And everything that is red is where GDP was negative, right? So these are all recessions, all these little red portions. This is what 23 million barrels per day of oil demand destruction looks like, right? And that's basically what we're talking about. A little bit better, 15 to 18 million, somewhere in there, probably. But like really bad. Like this is really bad. And I don't hear nearly enough people understanding you can't print oil, and the amount of oil that's being taken offline by attacks, by shut-ins, by the Strait of Hormuz being effectively closed is immense. It is 7 to 8 times worse than 2022. It is the worst energy crisis in modern history.
So I guess best ways to sort of hedge against this is to raise your income, have the cash,
have some of that
to make the cash,
and have low unproductive debt.
Got it.
So don't go rack up a credit card bill at 30% to buy a TV.
All right, smart. So you're not, and you're also not loading up potentially on how would and then we'll transition to the energy. How would things like Strive or STRC do you think perform in this scenario? I mean, they're cooked, like absolutely cooked. STR is done for, right? Like,
yeah, I mean, look, like maybe it survives. I don't know. I think ultimately it would depend on how quick this transition, right? So what I'm describing is an initial deflationary shock, right? Well, actually, first, what's going to happen is you're going to have an initial pop in inflation, right? Because oil's popped, so you're going to get this probably over the next month or two. Then those higher prices, which are required to reduce demand, that is that inelastic nature of oil, then those higher prices bite, right? And then you see deflation, go into a recession or depression, right? Depending on the severity of these things. Then this acts as a margin call. They print the money, and things go higher. The question is really how long in this phase do things stay, right?
Yeah.
During COVID, it was like immediate, right? It was very, very rapid. It all happened within a couple months, so if that kind of thing happens again, maybe, strategy could survive.
Mhm.
But if it kind of drags on and on and on, if if the Strait of Hormuz and the attacks on oil infrastructure in the Middle East, if those don't immediately end, and if they continue for another couple months, you're talking depression.
Yeah.
And because again, you can't come up with the energy, like the economy needs energy, right? Economic activity in the economy needs energy. Well, that energy, depending on how long it's offline, right now it's gone. If it doesn't come back, the economic activity will go down. It's just physics. And so ultimately it becomes a question of how long, this war, and this is part of why I think it's really so bad, is because I think Iran recognizes the leverage that they have. And I don't think that they're
Yeah.
gonna just give that
Yeah.
up. I think that Iran, Israel, and the US are all kind of like finally in this one, right? Like people in the US have been talking about war with Iran for my entire life. People in Israel have been trying to get America to get into war with Iran for my entire life.
Mhm.
People in Iran have been hating America for my entire life, right? Or the West, or right. Like all of these parties, these three parties have been, kind of like at this particular issue for my entire life. Well, it's finally happening in earnest. Like the point of no return, like, which party is not looking at this as an existential, this is our one moment. This is our one chance. This is
Yeah.
it, right? And so like Iran, I would argue, has the leverage here, which is the global economy, and being able to plunge it into a depression for however long they're able to keep the strait closed. I don't think they give it up. So yeah, ultimately becomes a question of how long this part lasts, right? If it's very short, then MSTR, STRC, all that might do okay. I'm not going to put any money in it,
Yeah.
but maybe it does okay. If this goes on for like another 2, 3, 4, 5, 6 months, it's done. It's done.
Yeah. God, dude, that'd be wild, man. So much rise in Bitcoin, so many assets, beta plays, double X lever. There's all sorts of things that are riding on Bitcoin's performance here. Wow, this is interesting. This is really interesting. You want to talk a little bit on the energy side of things, and then we can either we can start with, I know Rex shares some interesting stuff there, or we can finish with that. But
yeah, there's this 3x lever WTI. So like I mentioned earlier, if you're, look at that trend. This is pretty
yeah, it's
nuts.
nuts. Yeah, it is.
There's probably like, I'm not sure how they get the leverage, if it's options, if it's futures. So maybe some roll is involved with futures contracts, but yeah, but I think, personally, that like the bet, if you're a market participant and you have a view on the state of the situation in the Middle East, I think that the best way to express that is probably by Brent, not by WTI. Because Brent is, WTI is going to be able to be printed, or excuse me, is they wish they could print it, is going to be able to be restrained, constrained exports, export controls here in America. That'll be able to happen with WTI. Brent is much more of kind of a battle that Europe and Asia is going to have to face on their own. And so I think that, here, Thursday, so a couple days ago, Thursday, we saw the spread blow out to about $14 per barrel. I think Brent is if you're bullish on oil, if you are bearish on peace, right, and bullish on oil, therefore, I think Brent is probably the best way to trade it, because there's also theory that, or hypothesis, whatever you want to call it, that policymakers are shorting the WTI curve, the CL curve. So Maybe that's true. Maybe it's not. Apparently, the Monday that oil opened up super high, way back, it feels like ages ago, but it was just like 2 weeks ago. This day, apparently
Mhm.
on this day, this was all Sunday. Apparently on Monday, there was a huge seller of the front month contract that people hypothesize might have been the government. So, they're going to pull out every trick they can. It's not going to work. They're going to be the Bank of England rather than Soros and Besson and Druckenmiller that took down the Bank of England.
Yeah.
If they do that, it's dangerous game. But WTI, I think, has less upside to it. Not only are our policymakers willing to short the market, but also you have potential export control and our net exporter status and those kinds of things.
Yep.
But that's not to say that WTI still want to go up a lot. And if you're 3x levered to WTI, man, that could be pretty that could be pretty nuts.
A couple things there. Well, actually, you brought up Brent, and I believe Ostium we also work with closely. Just listed that on their site for trading as well. So they're definitely paying attention. Like, there's all sorts of ways to trade these markets if you're out there and you are able to understand TA and all that stuff. And again, what Robert was talking about there with the 3x levered one, that is from RexShares, our long-term partners here at Wolf, and also the sponsor of today's stream. And if you are interested in checking that one out, just hit that link in the tweet below the stream. If you're on YouTube, hit the description. You can find that if you want to check that particular asset out. They've got all sorts of stuff there. And you guys can check out their perspective as well below. But an investor should carefully consider a fund's investments, objectives, risks, charges, and expenses before you invest. Their fund's prospectus and summary prospectus contains this and other info about RexShares. And if you want to obtain that, again, visit their site at rexshares.com. That link is down below. Their summary prospectus and fund prospectus should be read super carefully before you do any sort of investing. So, again, very excited to be working with RexShares, one of our longest running clients. What do you got pulled up here? I see government bonds. I see.
Oh, this is the UK yield curve.
Nice.
They're talking about interest rate hikes.
Got it.
So yeah, their bond market is indicating interest rate hikes. So if you look, their overnight rate right now is 3.75. And if you look at their 2-year, it's trading at 4.4. So it's indicating multiple rate hikes in Great Britain. Now, it's kind of bad. I mean, it's really bad because that is the last thing that you want to do into an energy shock. Like, if anything, they should be cutting rates. I know it sounds counterintuitive, but yeah, it's pretty ugly here in the US bond market, but it's way more ugly in the UK bond market and the French bond market. Here, for example, is the 1 year minus the Fed funds. So generally, we've been pricing in cuts. The 1 year has been below the Fed funds rate. Well, we're 13 basis points above the Fed funds rate right now on the 1 year US Treasury yield, meaning, I would kind of loosely describe that as there being about a 50% chance, according to the bond market, that we get a 25 basis point rate hike over the next 1 year.
I've heard a lot of people talk about Europe. They're not so bullish on what's going on over there.
Yeah, no, you shouldn't be. or most of Asia.
Yeah.
It's really bad. I mean, this is really, really bad. And look, there's other issues too, which, like, you're Japan, higher energy price, you're getting squeezed. What do you do? Well, number one, that's going to weaken your currency. Well, weakening currency, we know they don't like that, right? They intervene. Well, what does intervening do? They're selling US treasuries, causing upper pressure on the interest rate, causing more dollar strength versus the euro, right? Now, versus the yen, they're able to buy the yen and sell the dollar, right? So the dollar is not strengthening versus their currency because they're intervening and they're buying their. But if you're Europe, you're getting screwed by Japan's action even more. So your oil bill is going up even. So, like, this could turn into like currency wars, right? Like, it is like biblically bad. There is no other way to describe it. There's no words to describe. If this doesn't end quickly, like very quickly, and a lot of oil starts to flow very quickly. If it doesn't, it's just physics. It's going to be really bad.
So what do you think is most important to pay attention to? I know we're coming up here on the hour. What are some last things people should be paying attention to if we have to, so if there's anything we haven't covered that you think is worth mentioning?
Oil. Just watch oil. Just watch what's going on in the Middle East. You know, like it's hard, you know. There's a lot of fake news on X, a lot of AI.
There's honestly a ton, actually. There's like there's tweets that are just downright not true, and it'll be like breaking some story, and people all in the comments are like, dude, this didn't even happen.
So going back to Russia, Ukraine, I started to develop a list of reputable open source intelligence accounts. I can't open source into, like, I have a list. If people reach out to me, I'll give it to them. People I know don't post fake stuff. Now they have biases and you have to know which account has which bias, but they don't post fake stuff, right? They don't post AI stuff. And if they make a mistake, which is rare, they they admit to it.
That's good.
I just follow that, and it's been a very, very, very reliable way to keep up with every missile barrage, every damage to a refinery, every development in the Strait of, like, you just gotta, I mean, because oil is everything right now. Oil tells you where VIX is. Oil tells you where the S&P 500 is. Oil tells you where bond yields are. It tells you everything. So, you know, this is what, if you take 2020, right, 23 million barrel per day disruption in oil, a negative demand shock, and it's a mirror, right? It's a mirror image of a supply shock, a 20 million barrel per day supply shock. Just if you take this a fractal of that period of time, right, where there was that 20, this is where oil went negative, right? It went negative 40. If you overlay that, we're kind of indicating like $165 WTI.
Man.
So you just have to watch oil. Oil is everything, and oil obviously predicated on geopolitics. So, you know, it's if that, you know, if markets are everything, you just have to know what's going on over there. It's unfortunate that it's happening, you know, and there's a real life, like, human consequence to it, which is a lot of death and destruction.
Definitely.
But that's just what's moving markets these days.
Yeah, it's getting intense. Like, all the rhetoric I see is around, you know, whether we can, you know, the world would look like with a $200 oil and a sustained price at $200, what that looks like. And then you get the people on crypto Twitter who half of them aren't even aware that that the crypto market's heavily skewed by what's going on over here. And if you're not paying attention to these sorts of topics, you're pretty much just going to be hung out for the slaughter, because you're not going to know why things are happening. They're just moving drastically on a Saturday for no reason. You don't know what's going on. So I appreciate you sharing these things, Robert, as always, dude. For people who are watching the stream, if you guys enjoy this kind of stuff, hit up Robert, hit him up on X. He's tagged right above. If you go on YouTube, the description, you can check him out as well. Check out his YouTube channel. He kills it over there. All sorts of content just like this. Robert, didn't know if there's any last things you have coming up, or things that are along your channel you wanted to shout out. Otherwise, dude, it's been a great stream.
Yeah. Worst energy crisis in modern history. And again, on par with the lockdowns of Q2 2020. Basically equivalent. It's time to strap in.
It's time to strap in. Couldn't have said it better myself. Well, listen, everybody, if you enjoyed the stream, please do take a second, repost it if you haven't already, and follow along here at Wolf Bitcoin. If you enjoy content like this, we try and do streams and spaces every single day here. We'll see you guys all in the next one. Hope you all have an amazing day. We'll be back on Spaces in about an hour-ish. So we'll see you there for that one.